Holy smokes, everyone. Bill Ackman, a legendary investor, has just put out a dire warning for the stock market and what's about to come. And for all those of you that don't know who Bill Ackman is and why should we listen to him, is he's a legendary hedge fund manager and he has made absolutely crazy returns in his hedge fund over the past 16 years. And Bill Ackman in 2020, he warned us that hell was coming, and oh boy did it come, and he pocketed $2 billion with his huge bet against the market. Not only this, but his hedge fund in 2020 made a staggering 70% return. But not only this, he's made an average return over the past 16 years of 16.9%. far outbeating the S&P 500's average return of 9.6%. And listen to this is how powerful the difference is. Say for example, you invested $10,000 for 20 years at an average return of 9.6%. After 10 years, that return would be $62,000. But if you were Bill Ackman and had a 16.9% return, look what your portfolio would be. $227,000. So this shows just by outbidding the market by 3 to 6% can make a huge difference over the long term. And listen to this, everyone. This is everything we've been discussing about on the channel. Billionaire investor Bill Ackman says sustained inflation could be a black swan risk for the stock market. People, everyone's warning about this, but I don't think the markets have fully priced this in, and I don't know investors really understand how dangerous this is. Let's have a listen to his recent interview with Wall Street Journal talking about these risks and what's going to happen to the stock market and the economy.
Sure. So I do agree. I think there's going to be inflation. I mean, you don't say there's going to be, there is inflation. It's happening. There's wage.
Is that a debate between like business people who are experiencing rising prices and addressing it versus economists who are saying, oh, this is just temporary blips coming out of the pandemic? I mean, where do you come down on that?
Yeah, I think it's not temporary. First of all, it's hard to roll back wages once you roll them up. I mean, they go from 15 to 12. You know, so I would say we have a new baseline in terms of wages, sort of generally. You look at every commodity price, right? New copper, lumber. You know, make your list. Look at what's going on in energy even before the colonial, pipeline issue. Look at housing prices. Look at Bitcoin, right? Everything is inflating. And that's driven by, we have a kind of a once in a moment in history, right? You have people emerging from a pandemic with the animal spirits that come from being locked in their homes, right? So that's dramatic. And then you have the Trump stimulus, the Biden stimulus, infrastructure, an extremely accommodative, Federal Reserve.
The Federal Reserve. Too accommodative, do you think?
I think they're going to have to raise rates for sure. And I think, they adjusted their policy, in my view, just at the wrong time. A preemptive policy toward inflation, I think, is a better approach, particularly in a world where we have, massive stimulus, economic stimulus.
Well, everyone, did you hear that? That was huge. He's saying inflation's not transitory like the Fed says. He says it is here to stay, and he says the Federal Reserve should have acted first. They should have tried to be proactive on inflation. Instead, he's saying they're going to be reactive and they are going to lift interest rates for sure. He's saying look at commodities, look at wages, look at everything. The proof is in the pudding. There's no more debate anymore. And he also said they provided way too much stimulus, but let's keep listening.
Too much stimulus? I mean,
I think with rates where they are, there's a very good risk of the economy overheating, which is why I think rates go up. And really the answer to the question that your viewer asked is you want to own businesses that have pricing power, and you want to own businesses where the value of the business is not going to change dramatically if rates go up.
Well, everyone, so this just confirms everything we've been discussing on the channel, and he did also give us a hint there that if you do want to invest in the stock market, maybe looking at companies that have pricing power and may benefit from inflation, like grocery stores or food stores, because if there is inflation, they're going to be lifting their costs too. These companies are a lot more fairly valued compared to these high growth tech stocks that have a lot higher PE ratios. But let's keep reading this article about what other risks are coming for the markets. So listen to this, everyone. I think one of the black swan type risks for the market is a real spike in inflation that's not just 3 months, that's more sustained, Ackman said. Also, meaningfully higher interest rates, which I think will affect the discount rates that people use to value companies, and I think those could be countervaluing stock market forces. So what he's saying here is people have been justifying these crazy prices for stocks because of low interest rates. But once interest rates creep up, people aren't going to be able to justify these stock values anymore, and the stock market has to correct. It is just simple economics and simple math. If interest rates go up 2%, the stock market could drop anywhere between 20 to 30%, and if inflation really does get out of control, all bets are off and we could see a complete market meltdown. Not saying that's going to happen, but it is a risk. Ackman did also say here that he thought that with the pace of vaccinations, the US would be close to full employment and near all-time low employment rates at the start of 2022, and this will be factors for the Federal Reserve having to change their policy. I think you could see certainly expectations change as soon as the next few months about how accommodative the Federal Reserve will be, Ackman said. And I can't wait to see what the Federal Reserve has to say in the next meeting, because we've got huge amounts of data that inflation is well above their target, and they're going to have to put out some really good excuse to justify the QE right now. And listen to this, everyone, but many on Wall Street have predicted that the Fed will need to change its hand sooner than expected, and it will spook the markets. Absolutely, will spook the markets. The markets have been pricing in the Federal Reserve thinking or talking about talking about tapering, but they haven't priced in high interest rates yet. The Wharton professor told CNBC on Friday that the Fed would change its policy stance in 2021, not 2022, and that it would cause a day of reckoning in the stock market. People, I'm telling you, this is a big risk, and it is looking more and more realistic every day. So everyone, what he says and what I agree with and what I've been saying is the Federal Reserve overreacted to the downturn. They provided way too much stimulus. They dropped interest rates too quick, and they're being too slow to rebound them back. And they keep saying, look, we're going to do this for jobs. We're going to do this to have wage growth. Yeah, you will have wage growth of say 3 to 4%. But if the costs of goods are going up 10 to 15%, you're losing money and they're fooling you. So the Federal Reserve has hit their goals pretty much. They just need a little bit more in the jobs market, but it's time for the Federal Reserve to do the job, and it's time for them to start lifting interest rates, because what's been happening lately is all the speculators, all the gamblers, all the risk takers, they have been rewarded, and all the prudent people that have saved, that have paid off debt, they have been punished. The retirees have been punished. Like I said, the savers have been punished, and it's time for the prudent people to be rewarded. So what should we do? Now, I normally wouldn't say this, but I'm thinking with all this craziness in the markets, this is not financial advice, this is a thought. If interest rates do go up and the dollar strengthens, none of these assets are going to be safe. Real estate will go down. Stocks will go down. Precious metals, if the dollar gets really strong, that's bad for precious metals and commodities. So it may be time just to have a little bit, not, all your money in the one basket, but just to have a little bit of cash on the sidelines, because if the dollar does strengthen, you'll profit from that cash. If interest rates do go up, you may finally start to get some interest on that cash. And if stocks do fall down 20%, well, even though you haven't made a 20% return, you've saved 20%, and then you can go shopping and buy everything on discounts when there's blood in the streets. So everyone, what do you think about this? Do you think Bill Ackman is right, or do you think he's dead wrong? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you up to date on the latest that's happening in the stock market, the housing market, cryptocurrency market, and global finance news. If you're bored, I'll put up some other videos here. I'll see you there.